Tantor Audio, a division of Recorded Books, presents Business Valuation for Dummies by Lisa Holton and Jim Bates, narrated by Walter Dixon. Publisher's Note: this audiobook refers to figures and tables included in the print and e-book editions of the book. Limit of liability, disclaimer of warranty. The publisher and the author make no representations or warranties with respect to the accuracy or completeness of the contents of this work, and specifically disclaim all warranties, including, without limitation, warranties of fitness for a particular purpose. No warranty may be created or extended by sales or promotional materials. The advice and strategies contained herein may not be suitable for every situation. This work is sold with the understanding that the publisher is not engaged in rendering legal, accounting, or other professional services. If professional assistance is required, the services of a competent professional person should be sought. Neither the publisher nor the author shall be liable for damages arising herefrom. The fact that an organization or website is referred to in this work as a citation and/or a potential source of further information does not mean that the author or the publisher endorses the information the organization or website may provide or recommendations it may make. Further, readers should be aware that Internet websites listed in this work may have changed or disappeared between when this work was written and when it is read. Introduction. No two businesses are exactly alike, even those that are part of a national chain with exactly the same sign on every door. Each business or outlet of a business has its own complexities that determine whether it's worth a little or a lot. That's why business valuation is actually a pretty complex affair for someone who's never taken a finance class. If you go online or into a bookstore looking for books on business valuation, you're likely to find volumes that are written more for people who've already been exposed to business finance, accounting, or management training. If you're considering buying a business or have operated one for years without a lot of that training, we're pretty sure that a complicated textbook isn't what you need. We think that valuation should be the first thing you think about before you make a move into or out of any business. Consider this book to be a starting point for a bright, well-informed future in buying or selling a business, because the dream of owning or selling a business should always begin with dedication to understanding the true value of what you're buying. If we can give you an understanding of the basics of business valuation and of the tools and expertise you require to get the right valuation for the job, we'll have accomplished our purpose. About this book. This book is very cautious, because we think it should be. We'll state this up front. This book will not make you qualified to handle most business valuation tasks by yourself. Nor will you have a complete background in business accounting or business law when you get to the last chapter. The purpose of Business Valuation for Dummies is to give you an overview of all the critical skills, issues, and methods involved in small business valuation without taking you through all the detailed theories and number crunching necessary to the process. Other more advanced resources are out there to show you those processes when you're ready. But by the time you're done with this book, you'll know which basic processes, resources, experts, and tools you need so you can put together the fairest and most affordable valuation solution for the business in question. We tell you what various professionals do in the valuation process, but we don't tell you that you can do their job. We also tell you the many steps you can follow to educate yourself about valuation in general and your target business in particular, as well as how to make the right decisions to get an accurate valuation of a business. For instance, you can consult resources free or nearly free of charge to build a baseline of the business you're considering, and then move on to the basics of valuing that kind of company. We tell you about those resources in this book, discussing rule of thumb valuation and other resources you can consult early in the process to start building knowledge. We encourage you to do this basic research before you even think about buying or selling a company. And yes, even if you've owned a business for decades, you need to do this research before you sell. If we've done our job, this book will give you a thorough summary of all the steps in effective valuation and show you how to plan and execute that process. We give only 2 detailed examples of valuation in this book, one for the sale of a business and the other for a purchase. This way, you get a close-up look at how an isolated example works, which we think makes a lot more sense than attempting to generalize for every possible situation, which might mislead you. This book adopts a holistic approach that involves expertise not only for business valuation, but also for your personal and family finances. Why? The decision to buy or sell a business is a major life step. It's not just about the business. Ownership is tied to one's personal finances and family goals, and business valuation needs to tie into all those things. Even if you have a small business and a small family, getting advice tailored specifically to your circumstances is usually smart. Last thing, because one of the authors of this book is a valuation professional, you may say, "Oh, that's why they keep saying to use an expert." Keep in mind that we don't say which experts you need to use. You have a choice. But anyone who wants to be in business needs to know that tax, valuation, legal, and finance issues are interconnected, and you need people with excellent skills helping you manage these subjects if you don't have the expertise yourself. Conventions used in this book. Regarding web addresses, when you use one of these web addresses, just type exactly what you hear in this book. We note new terms by following them up with easy-to-understand definitions. Foolish assumptions. This book is designed for 2 kinds of people: those who are thinking about buying a business and those who are considering selling one. We consider this book to be optimal for people who want to go into business for themselves for the first time, because it addresses the critical knowledge that all good business people have: the ability to maximize value at all times. If you're planning to sell a business, we provide a planning outline to allow you to maximize the value of your business before the for sale sign goes out front. Here are a few assumptions we make about you, the reader, whether you want to buy or sell. You're probably looking at a company of less, sometimes significantly less, than $5 million in annual revenues. This book focuses mainly on the purchase and sale of private companies, that is, companies that don't trade daily on a major exchange. You have some experience with the business world. However, we don't assume that you have a background in finance or valuation, which are frankly 2 different and very complex disciplines. More than anything, we assume that you don't want to be taken to the cleaners on your first foray into business or your last decision with the business you own. Perhaps you've watched other people go into business and you just know that they don't have any idea what their business is truly worth. They've negotiated up or down with a seller, but they haven't fully kicked the tires. That move isn't the kind you want to make. You realize you need industry, financial, and operational knowledge to make the best decision. How this book is organized. Like all the other For Dummies books, this book is divided into parts, and each part is divided into chapters. What follows is a summary of what you can see in each part of the book. Part 1. What business valuation means. We start by telling you what business valuation is and why we think it's the first thing you should understand about being in business. We talk about why valuation is such a challenge, and we give you the basic accounting approaches that experts take to uncover value, or the lack of it, in an organization. Last, we talk about the greatest valuation challenge today: how experts evaluate what intellectual property means to an organization. Part 2. Getting familiar with valuation tools, principles, and resources. This part is where we spend the most time talking about paperwork, process, and expertise. We talk about what a valuation report looks like and what various professionals do in the valuation process. We offer a primer on financial statements and how they're used in the valuation process. We also offer an important chapter that talks about rule of thumb valuation information, where it can help and where it can mislead. Part 3. If you're selling a business. People sell businesses for lots of reasons. They're sick of running the business, for example, or they've made the business a rousing success that's ripe for a nice price from a new owner, or they're ready to retire or to pass on what they've built to the next generation. The reasons can vary, but one thing is clear. Planning for the sale of a business is something that you don't just do a few months in advance. The planning takes years and is best thought of as part of a founder's overall estate strategy. If you build a business, you want to get the best value for it in a way that allows you to enjoy the full rewards of what you created. So if you're trying to figure out what to do with a family-owned company, this part is for you. Family businesses supply an incredible amount of drama in the valuation process. This part also introduces a detailed case study on the sale of a fictional business. Part 4. If you're buying a business. Knowing about basic valuation issues is the key to making a deal. Buyers have to do their own planning for a transaction because they may be going into business for the first time or buying another company in a series of companies to complement existing business interests. And, of course, buyers have their own succession and estate planning issues to deal with. In this part, we discuss valuation issues for the buyer and feature another major detailed case study, this one on the purchase of a particular fictional business. Part 5. Don't try this at home. Turning things over to the valuation experts. The purpose of this part is not to win business for valuation experts, even though we clearly believe that these chapters cover situations in which you need help. The idea is to communicate why the complexity of certain valuation situations should encourage you to seek help. This part includes 3 chapters that discuss situations in which business owners definitely shouldn't go it alone. Which situations did we choose? Divorce certainly qualifies, because it endangers many family companies. Estate planning and gifting are tied with the value of the family business. Therefore, they need joint coordination. Finally, people need valuation advice when they're preparing to attract outside investors to a business. Part 6. The part of tens. These 3 chapters offer 10 points of interest each on the following topics: reasons to consider a prenuptial agreement, elements to build into a partnership agreement, and things to consider before transforming a conventional business to an employee stock ownership plan, ESOP. Icons used in this book. This book uses the following icons to highlight key information. You will hear these icons verbalized in this audiobook. Tip. This icon calls your attention to particularly important points and offers useful advice on practical financial topics. This icon saves you the cost of a yellow highlighter pen. Remember. This icon serves as a friendly reminder that the topic at hand is important enough for you to put a note about it in the front of your wallet. The icon marks material that a college professor would put on the board before class starts, noting the important points that students should retain at the end. Warning. This icon warns you about speed bumps and potholes on the valuation highway. Taking special note of this material can help you steer around a financial road hazard and keep you from blowing a fiscal tire. In short, watch out. Technical stuff. This icon marks non-essential information, such as statistics and history lessons. The ideas here are interesting, but you can skip this text if you want to get back to the basics. Where to go from here? We really enjoyed writing this book. We particularly like the idea that we can get small business people thinking about the importance of valuation early in the life of a business. If you know nothing about the business valuation process, we suggest you start with Part 1. But this is a reference book, so feel free to jump around a bit. For example, you can see how specific situations are handled in Part 5, and if you want to see detailed case studies on valuations, by all means, head to Chapters 13 and 18. Part 1. What business valuation means. In this part, many people think that business valuation is all about getting to a price for a business, and that's certainly a big part of it. But we think that valuation is the central concept of what makes a business, and that very few people really understand it. In this part, we discuss the reasons valuation happens in a business, and we introduce the accounting concepts in the process. Most importantly, we discuss valuing business ideas. Chapter 1. The Value of Understanding Business Valuation. In this chapter, why the price of a business is only half the story, the importance of planning in valuation, basic due diligence, why families are so important in the process. You're here for one of two big reasons. You have a business that you want to sell, or you want to buy a business. Very likely the business in question is a small business, with less than $3 million in annual sales, and it may be the first and only business you ever own. Before we go further, we want to pay you a compliment. Right now, you're doing something that painfully few entrepreneurs do, thinking about what a company is actually worth before you make a major decision or take a major action. You're already ahead of the game. And because you're reading this book, you obviously know that business valuation is an important part of that game. Business Valuation for Dummies is for people who want to understand value. This book can help you get your arms around the many tasks and variables involved in effective valuation of a company and help you decide what kind of help you should enlist to complete a deal. In this chapter, we discuss the importance of valuation, talk about doing research and calculating value, and include some notes on valuation experts and intellectual property. We wrap up with a discussion of passing a family business from one generation to the next. Basic tenets and the importance of valuation for business people. Everything has value. Putting value in dollar terms is the cornerstone not only of running a business, but also of investing in almost any form. Knowing how to arrive at a value for the physical and intrinsic characteristics of a business is essential to building wealth of all kinds. To that end, people who invest in companies need to look beyond the current state of the business they own or want to own, and consider what decisions they need to make to boost value. People who have experience in those industries are often best equipped to make those decisions, but it often helps to engage a business valuation expert for guidance. In this section, we discuss the concept of value and note some of the main principles of business valuation. Value differs from price. As the celebrated investor Warren Buffett once said, "Price is what you pay, value is what you get." We would add one more line, if you do your homework. In business deals, most buyers and sellers have a singular focus on price, and price is hard to avoid. Negotiations ideally produce numbers that both sides can be happy with. But getting to the right price in any deal involves understanding what business assets are truly worth, and then structuring a deal around financing and tax realities, which can be quite surprising to those who fail to plan. Planning drives value. Creating value is a transformative topic in business planning and execution. If you're creating a product, granted that product is the focus of the business for customers and your employees, creating value, long-term growth and asset value in a company you've built, is something you need to focus on, because a company is the sum of real and tangible assets, investments, ideas, and management talent. If you can look at all those working parts of a business through the prism of value, the desire to determine and create value in a company can become a much more important driving force in its growth than simple profits and losses. Remember, proper valuation takes time. People buy and sell businesses for a variety of reasons that aren't all about business. For instance, they make moves in and out of companies based on career goals. Others devote a lifetime to a business so they can finance their retirement or simply pass the business on to their kids as a legacy. All these motivations drive valuation and should require 3 to 5 years to account for owner's estate, succession, and exit planning. We talk about the importance of planning throughout this book. Tip: one of the best places to start finding out about the planning process for starting a business is the U.S. Small Business Administration's website, sba.gov. No two valuations are exactly alike. No two businesses are exactly alike. Neither are the goals and circumstances of business owners. You may be in any of a variety of situations, such as the following. You may be the child of a company founder, wondering whether you want to take over the company when she retires. You may be a corporate executive who's ready to start a new career with a new business purchased with a cash buyout. You may be a worried sibling trying to figure out what to do with the family company because the company's founder, your father, has died suddenly. Valuation isn't an exact science for another reason as well. The risk inherent in any business situation is far from static. Depending on the economy and the state of the industry the business operates in, the company may be under tremendous pressure to stay afloat, or it may have great opportunities for growth. Anytime the economy goes through a major convulsion, people take a fresh look at what value means and the realities of any deal. As we write this book, the nation is in the grip of a worldwide credit crisis, an economic slowdown that is redefining the values of a host of assets, from companies to private homes. All these variables are one reason you won't emerge from this book with the skills to do a top-to-bottom business valuation. Also, proper business valuation takes a lot of practice. People with finance degrees and long experience in accounting or other numbers-related fields aren't always naturals at valuation either. Don't worry, though. This book does cover the ins and outs of business valuation and points out the areas in which you can handle valuation on your own and those for which you should hire some help. Valuation isn't a one-time deal. Tip: if you're already operating a business to its fullest potential, valuation isn't something you should put off until you're ready to sell or close your doors. Most tax, business, and personal finance experts say that even if you're years away from retirement or years away from your next business idea, keeping your valuation numbers current is a good idea. This way, you can make changes and investments in the business so you can leave the business with the highest valuation possible. A strategy of continuous valuation tells you the following things: whether selling your business or merging with another makes sense, whether you can make enough money from the sale of a business to support your retirement, when you want to set a timetable for your kids or other family members to take over the business, the optimal time to set up an employee stock ownership plan, ESOP, as a way to pull money out of the business in a tax-advantaged way. How often should you run your valuation numbers? Frankly, it varies based on need. With computerization, it's easy for many businesses to program their numbers so they can keep a constant eye on their main value indicators that have been developed for any goal they have on their radar. Tip: if you're working with a business or tax planner, discuss the creation of a valuation system for your business, whether it's something you access yourself or have an expert handle at regular intervals. Seeing what the finished product looks like is a good starting point, so skip to Chapter 6 for a description of a typical valuation report. The basic building blocks for calculating value. The three top associations for valuation professionals are the American Society of Appraisers, ASA, the Institute of Business Appraisers, IBA, and the National Association of Certified Valuation Analysts, NACVA. These organizations agree on three major approaches to business valuation. The asset approach, also known as the cost approach. This valuation approach is based on finding the fair market value of assets, the easiest ones to value are tangible assets, and deducting the liabilities to determine the net asset value, or the net worth of the business. The market approach. This approach compares your company or a target company with similar companies. You can use comparisons to publicly traded companies or actual sales transactions for similar businesses. These valuations are frequently expressed in ratio form. The income approach. This approach focuses on the future economic benefits you're anticipating from a business, better known as income. This amount is expressed in today's dollars and is also known as present value. For more information on these three approaches, see Chapter 4. In this section, we discuss some of the basic ideas that go into calculating value. Discount and capitalization rates. the numbers that really matter. Most of the number crunching that goes into valuation doesn't take on real meaning until appropriate discount and capitalization rates are assigned to the valuation itself. These computations allow valuation to become much more meaningful in light of the business the company is in and the various attributes to its industry. We discuss these concepts in Chapter 6. Doing your homework. Due diligence. The term due diligence means investigating a company with the cold eye that you should bring to any investment. For anyone doing the job, due diligence involves reading everything, asking plenty of questions inside and outside an organization, and generally leaving no stone unturned in finding out what makes a company tick and how much it's truly worth. Due diligence involves not only basic research and calculations, but also the ability to forecast how a company will do years from now. Whether you're a buyer, see Chapter 16, or a seller, see Chapter 12, or whether or not you're enlisting help with a transaction, due diligence starts with your intentions toward any company. Both soft and hard skills are involved in valuing a business correctly, and in the chapters in Part 1, we talk a great deal about the early stages of company research and what you can do to inform yourself about the worth of the business, even if you've never been in business before. How rule of thumb enters into business valuation. Rule of thumb is a starting point for civilians in valuation, a way to get a general idea of what companies in certain industries are worth. The rest, you have to investigate thoroughly on your own and with the right help. But here's some key points concerning what you're about to see. Tom West is a founder, past president, and former executive director of the International Business Brokers Association, IBBA. For the past 18 years, he's been the author of The Business Reference Guide, an annual Bible on pricing for hundreds of categories of independent businesses and name-brand franchises. In Chapter 9, we feature rule of thumb guidance for 10 kinds of businesses from data West has compiled for the BRG and listings on his subscription website, Business Brokerage Press, bbpinc.com. In West's guide, rule of thumb guidance comes in two formats that most valuation experts recognize. Percentage of annual sales. If a business had total sales of $100,000 last year, and the multiple for that business was 40% of annual sales, the price based on that particular rule of thumb would be $40,000. Multiple earnings. An earnings multiplier makes the most sense to prospective buyers. It directly addresses the buyer's motive to make money, to achieve a return on investment. In many small companies, this multiple is commonly used against what is known as seller's discretionary earnings, SDE, which are earnings before accounting for the following items: income taxes, non-recurring income and expenses, non-operating income and expenses, depreciating and amortization, interest expense or income, owner's total compensation for one owner-operator after adjusting the total compensation of all owners to market value. Chapter 9 gives you more details on how rule of thumb guidance applies in specific business situations. Getting expert help. The authors of this book share a very precise bias. We believe that no one should attempt this process alone, unless he or she has been trained and licensed to value companies. Plain and simple. It's a very good idea to enlist help whenever you're in the valuation process. Valuation experts can help a business owner locate key benchmark data and other information that shows the worth of companies demonstrating the best practices and best performance in an industry. Valuation experts, the best ones anyway, aren't generalists. They do have general skills in finance that allow them to make mathematical calculations, known as tests, that are relevant to finding what particular assets are worth. But certain valuation professionals specialize in specific industries and deals. Some work with manufacturing assets, for example, whereas others work with intellectual property. Others handle mergers and acquisitions for companies of a particular size. The various experts in the valuation process include the following: appraisers and valuation experts, accountants and forensic accountants, attorneys, business brokers.
Sample complete. Ready to continue?